Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Some mutual fund houses have cut the expense ratio on Nifty 50 exchange traded funds or ETFs to bring down tracking error and led to higher returns for passive investors. Remember, the expense ratio is the total expense charged by the scheme. Now, let's welcome on board Nirav Karkera, Head of Research at Fisdom, and understand how will this move affect investors. Nirav, good evening. Welcome to the show. So let's break it down for the investors. What do you mean by total expense ratio in the first place?
So total expense ratio, like it almost literally suggests, it is the total expense that is charged to a fund. It is as generally termed in percentage terms as a percentage of the total assets. So that is total expense ratio.
That there's a consultation paper that's given out by SEBI, and all the stakeholders would be later on consulting SEBI on the same thing. But then let's focus on this particular news where we see that ETFs and the expense ratio on ETFs have been cut by a few AMCs. Now, what does this indicate, and what cut are we talking about in the expense ratio?
So ETFs, exchange traded funds, are basically similar to a mutual fund, but they are traded on the exchange, like the name literally suggests. And there are a few AMCs that have decided to cut the cost that is incidental to investing in ETFs furthermore. Now, ETFs, as is, have been relatively low cost products. Because most ETFs aim to replicate, especially in this context, when we are talking about the cost being cut, it is majorly in context of ETFs trying to replicate or track an underlying index, in this case, very specifically Nifty 50. So the cost attached to such Nifty 50 ETFs were, as it is, marginal. As you can see, most of the ETFs following Nifty as an underlying has an expense in the range of 5 to 7 paise, which is 0.05%, 0 to 0.07%. There are a few beyond the range, but generally it is in this range. So these are really affordable, low-cost alternatives to trying to get an exposure to the performance of Nifty without shelling out a whole lot more in terms of expenses. So this is also one of the reasons why passive investing has been all the rage in recent times, because of the very low cost and the fact that this could be an alternative to certain funds that find it difficult to outperform the index. And if one were to believe that indices would continue performing, such a low cost structure would be highly beneficial to an investor.
Also explain what exactly is tracking error and how is that being considered over here?
Yeah, so tracking error, again, like with most other terminologies that we spoke about, is quite literally what it talks about. It is the error in tracking the performance of the underlying index. To simplify it, there is an index like Nifty 50, for example, and there is a Nifty 50 ETF. Now, the ETF tries to replicate the performance of the Nifty, and that is done by trying and at any given point in time having a composition that is similar to Nifty 50. Now, at this point in time, there could be certain patches where an ETF is unable to replicate the underlying index, that is Nifty 50's performance. Now, most of the deviation in performance, like for instance, if Nifty has gone up by 10%, one would quite often notice that the ETF has gone up by probably 9.9% or in the ballpark. So they aren't quite able to replicate the performance. So most of this leakage is attributable to the cost also. So while Nifty grows at a certain pace, and let's assume there is no deviation at all, and the ETF is doing its job really well and constantly replicating the performance of Nifty 50, which it should ideally, there will still be a difference in the performance, and quite often than not, I mean, typically the ETFs will slightly underperform the index. Now, this underperformance or this deviation, this difference, is called as tracking error.
Investing, you can go through the index route and you can go to the ETF route. Now, because there is a cut in the expense ratio for ETFs, you think the demand or the kind of liking towards ETFs and index funds that we've seen lately, people are turning into becoming passive investors also now. At least they have started to become now. You think ETF will gain the momentum after this cut, or it doesn't matter, it's just negligible?
Yeah, so passive is the adoption of passive is on the rise, but this has more to do with the merits of passive investing and the ability of the restricted ability of certain funds to outperform the index. Obviously, a reduced cost makes it all the more lucrative for an investor. It in a way it just passes on the performance in a larger quantity back to the investor. It makes the investment a whole lot more cost efficient and effective from a performance tracking standpoint. However, the difference is so negligible considering the very small base of expense that was already there. The difference might be very negligible at first sight. For instance, we about how a couple of funds were earlier charging 0.05%, but is charging now 0.03%. So it would seem like a very minute and small change of 0.02%. But if you look at it from a cost standpoint, in absolute terms, it is a cost saving of almost 40%. If you were to convert it in rupee terms, the cost that you would incur earlier versus the cost you would incur now, and this becomes all the more prominent in case your portfolio size keeps increasing. Such a cost saving becomes highly lucrative as a proposition to investors. So yes, I wouldn't say that the difference is insignificant because that is how the percentage points would look. But if you convert it into absolute values, we are looking at a 30 to 40% decrease whenever 5 paisa or 0.05% cost structure moves to 0.03%.
But this still should not be the reason why you want to buy an ETF, right?
Absolutely not. So the ETFs are like with any other financial product, it serves a particular purpose. It has a very specific objective. In this case, it tries to replicate the index performance. Let me put it this way: it doesn't really matter what your cost is if your post-cost performance is not really what you expect it to be. And so you can take two examples. Let's say hypothetically, there is fund A where you generate 20% returns and the cost is 10%, let's say, and you generate a post cost return of 10%, and let's say there is a fund B that generates 12% returns but has only 3% of incidental cost. You are still better off choosing the first product. So any decision based on cost alone will not really point you towards the right direction. What matters is how efficient the product is, how effectively it aims to capture the objective that it is trying to capture in the first place, and how does it strategically fit within one's portfolio. Just because something is cheap doesn't mean it is good. It needs to solve a purpose.
All right. Thank you so much, Nirav, for being on the show and helping our viewers understand all the aspect of expense ratio going down on selected passive funds. Thank you so much.
Thank you.
So we at the Times Network are back with our flagship event, India Economic Conclave, which is known to set the stage for driving India's economic agenda as we move forward on the path of integrated, equitable development, which is all-inclusive, all-pervasive, universal, and one that strengthens not just the Indian economy, but the global one as well. To pursue this agenda, the theme for this year is India, the emerging third superpower. IEC will feature the biggest voices from politics, global markets, economy, and corporate world. So get ready to catch all the action here on Times Network.